Brief intro. There are people here who are meeting me for the first time, so I thought I'll just spend a minute on that. So I'm Prabha Srinivasan. I'm a founder, CEO of Ventura Pranas. It is a cross-border advisory and compliance firm specializing in US and India tax and compliance and advisory. And we are a 100-member team, and we're located between Chennai, Los Angeles, Trichy, and Bangalore. I'm dual certified, and that was the genesis of the firm, and we've grown since our formation in 2011. We'll start a little bit with residential status. So you all know you're selling Indian property, and when you're looking at filing status in India, you're either looking to be a resident or a resident not ordinarily resident, or a non-resident, depending on where you are. And what these three different categories really distinguishes how you report foreign income. And we're not dealing with foreign income here, right? We're dealing with Indian sourced income. And therefore, it becomes taxable, regardless of which bucket you fall into. And so I'm trying to keep it really simplified for you to tell you that don't worry about whether or not it's taxable. It is taxable. And then the second part that's even easier is that the rate is the same. It does not matter that you're non-resident or resident or RNOR. The rate is 23.92%. You can credit the new Finance Act for pegging the surcharge at 25%, which has helped us freeze the long-term capital gains, which applies to assets held for more than 24 months. It used to be 3 years. It's now become 2 years in India to qualify as long-term. And so that is your rate. And if you hold the asset for less than 24 months, you're looking at a 39%. Now, that's so much better than the 42.5 that many of our clients were coughing out as early, as recent as 2 years ago. So that's a bit about holding period in India, as well as the rates for short-term and long-term. And then we'll switch gears now and talk a little bit about residency in the US. Now, if you're a green card holder or a US citizen, you could be living on the moon, but you would have to file a return in the US, which means you will have to declare worldwide income. It does not matter which part of the world you earn it. So it's a no-brainer. You've got Indian capital gains income. You have to report it on the US tax returns. The question then becomes, what about resident aliens? Now, these are people who are on non-immigrant visas. They're either on an H-1B or an L-1 or an O-1. And these are people who are spending a significant amount of time in the US. And without going into the complexities of what constitutes substantial presence, let's just say somebody who spends more than 183 days in the US, he's bound to report worldwide income. It does not matter that he doesn't hold a green card or citizenship yet. His obligations remain the same. We come to the very last category, which is a non-resident alien. Now, this is an individual who is an alien from a US standpoint. I don't know why they call them that, but these are people who do not spend significant time in the US. Typically people who fall in this bucket are H-1B people who have returned back and still continue to retain some income sources in the US. They do not and are not expected by the US government to report foreign income. So your Indian real estate sales are purely taxable in India. They are not taxable in the US. I've also made reference to the tax rates for you. The capital gains rates in the US, many of you know there's a 15% and a 20%. But for the purposes of this presentation, we're just going to keep it simple and assume everybody has hit the 20% mark. And so that's the straight capital gains rate. And then the US has something called net investment income tax. It's a 3.8% tax, and it is a below-the-line tax. In other words, it is applied on worldwide investment income. So it takes the total rate to about 23.8%. Vis-a-vis the 23.92 in India. And then you've also got short-term, and keep in mind, US is very simple. You keep an asset for over 12 months versus the 24 months in India, right? Under the Indian rules, you've already hit the threshold to make something a long-term asset. So if you keep something for under those 12 months, you're looking at short-term rates, and that's your top rate. Everybody who files US returns with us, almost all of you on this forum are those. 37% is the top rate. So, and then you add 3.8%, it takes you to the 40.8, okay? So the one thing you will see is, yes, these are absolute rates, but keep in mind that there is an interplay of foreign tax credits. There's no getting away from Indian tax. It's an Indian asset. You're going to pay the taxes to the Indian government, but the promise of a credit on the US tax returns will reduce the tax burden on an overall global scale. So that's a little bit about residential status from a federal and Indian standpoint.